Hello and welcome to Gold and Silver Assets. It's Diora here on Sunday, the 14th of February 2021. In last week's show, when I proposed a trajectory for the silver price, a couple of people thought that I meant that was the whole bull run and that the silver price would peak at over $90 in October this year, and that would be the end of the bull market and a bear market would ensue. But no, actually, I think that the bull market will run well beyond 2021. But that got me thinking, how long can we expect precious metals bull markets to run? Let's start by discussing what a bull market actually is. In fact, why do we even use the terms bull and bear? These terms are actually centuries old, and there are multiple theories regarding their origins. Some say that it's derived from the way each animal attacks its opponents. So a bull would thrust its horns up in the air, while a bear swipes down with its claws. Some say that the term bull is used because the New York Stock Exchange is built on land that was used by the Dutch in the 17th century to auction off cattle. Others say that it's because in rising markets, these were fueled by fast-talking brokers with exaggerated claims about stocks, so they were spouting their line of bull. Interestingly, there's no consensus regarding a precise definition of a bull market. It's not actually as clear-cut as you might imagine. A bull market is commonly defined as a 20% rise from the most recent lowest point. And that all sounds great, but it does mean that a big chunk of the move has already happened. And it's one of those things that only really becomes apparent in retrospect. Others say that we're in a bull market when prices are tending to rise. But again, that is a bit vague and subjective. So this is yet another example where your timescale is also a really crucial factor to consider. As you'll know from my previous videos, I do keep banging on about the importance of defining your timescales. The reason for this is that in this case, both bull and bear markets can exist simultaneously, but in different time spans. These time spans can be classified as shown here. So you can call them secular, primary and secondary. Now there's no fixed definition for these either, but broadly it's said that a secular bull market is in the order of decades, a primary bull markets are in the order of years, and secondary bull markets last weeks or months. But as I said, don't get too hung up on these timings. Again, they're not exact. These are just kind of vague classifications here. Here's the chart for gold priced in US dollars on the monthly scale. And as we can see from this big move up here, then basically we can say that we've been in a secular bull market for gold since around 1999. Up until 2011 up here. We can also say that we had a primary bear market because of course this was under a decade, but again some argue that that could be a secular bear market, and that started around 2012, 2011. The question is, when did it finish? Some say it's 2016 over here because that was the lowest point. But then again, price kind of moved sideways here before moving up. So some people would say it was 2018. But then again, this rise was more than 20%. So it's a kind of grey area here regarding when the ensuing bull market has resumed. The other thing here is that within this bear market, there were lots of small secondary bull markets here. So we've got one up here, one up here, one up here. And again, those just lasted for short durations. I think it's the secular bull markets that most of us are going to be most interested in. So the first thing to note is that when assessing this, we do only have data available from 1971. And this does contrast with analysis that you'll see about bull markets in the general stock indices, where there's over a century worth of data there. As we can see here, the first major bull market in gold from 1971 to 1980, so that lasted 9 years here. And I've put a question mark over here because we don't actually know when it really started, because before 1971 the price of gold was fixed by the government. We can see that this bull market had 2 stages to it in terms of bull runs. So there was one bull run over here and then a second one here, and that was separated by a primary bear market over here. The secular bear market that followed, so that's this over here, that was quite long and grinding, and that lasted 19 years. So that was a pretty painful time for anyone who was interested in gold. In fact, a lot of people lost interest in gold over that duration. But that was subsequently followed, I think we could probably say the low was here in 1999. That was followed by another secular bull market that lasted 12 years. And again, we had some primary bears in between that. Or actually, I mean, that was actually less than a year. So it could be actually more of a secondary bear market within that. As I mentioned in the last slide, that secular bull market was followed by a primary bear market, and there's some debate about when that ended. So it's either 2016 or 2018. But look, regardless of which of those dates you prefer to choose, it's clear now that we are in a bull market here. We've had a well over 20% rise in prices. But the other thing is that we've made a new all-time high as well, even though we've bounced back down from there. That is, for me, an important milestone there. So to me, both the fundamentals and the technicals all point to us being in what I think is the next secular bull market. And that either started in 2016 or 2018. Overall, there's not really enough price history to make any accurate assessment, but we can make some rough estimates regarding the length of gold bull markets. I think it's reasonable to consider that we are in a secular bull market in gold. Based on the history, secular bull markets in gold run for at least 10 years. Therefore, if we are being conservative, then I would say that we have at least 5 years more to run, if not longer. That suggests that for those that are new to this sector, you're by no means late. Next up, the market update. I thought we'd start this week's market update by looking at the premiums for silver and for gold, because obviously we had quite a bit of excitement a couple of weeks ago. Let's start with the silver premium over spot. And as we know, premiums shot up well above 60% over there, and they have since cooled off. And at the moment, they're about 30%. Now, remember that this still is pretty high as far as premiums go, certainly well above the longer term average, which is usually more closer to 10% actually. So this year, the whole year, we've seen above average premiums for physical silver over the spot price. And in terms of gold, and of course, gold has been behaving differently compared to silver in terms of the spot price. So silver has been behaving with some strength, whereas gold not so much. But interestingly, and this is, I think, something quite important to note, is that the premiums have been gradually rising, and currently they're over 12%. And so both of those, to me, tell me that physical silver is getting harder and harder to get hold of, and that's probably one of the big reasons why premiums are so high. And of course, the whole year they've been well above the longer term averages there. So to me, that just seems like a bullish sign. Let's move on to gold priced in US dollars on the daily scale. And yeah, we're still in this correction. It's getting long and boring, and yeah, I'm still bullish. I hope I don't sound like a scratched record, kind of saying the same thing most weeks, but at the moment we're kind of in this sideways action here, and so that's when things do get boring. But look, I'm still thinking that this is going to break out upwards, and I think when it does, it could be epic. But we've just got to sit through this. This is kind of price coiling like a spring, ready to be released, and we just got to be patient. How long is this sideways action going to last? Well, nobody knows. I'm thinking probably early to mid-March. So yeah, the next few shows might be a bit boring, but look, I'm going to try and add some things to try and mix things up, and you know, I'll throw in new ideas and things like that. So at the moment though, this zone here, which we've been talking about for quite a while, remains pretty strong. Here we kind of poked into it and just got rejected. Here we had a little bit of a longer time in that area, but again, price bounced off of it. But the only problem here is that we didn't get a new high there, so we're getting still in a short-term downtrend here. We may well test this zone again. If we do, I've just joined these two lows here just to see. Now, there's no reason why that has to necessarily hold, but you know, we're trying things out here. Just in that last day, price did try and approach that zone and again got rejected. So it doesn't even necessarily have to go in there, but if it does, I'm thinking that this would be the level, which is just below 1800 there. But yeah, I think we've still got a bit of sideways action before we start making our way upwards. I'd want to see us start getting above 1880, and then we can talk about 1960, and then beyond that I'm going to be very, very positive after that. There is still that fear of price going down, but interestingly it wasn't quite as much fear as I thought. Last week I was concerned that people might be getting a bit bearish, a bit fed up, and worried about big price drops, but actually that wasn't the case. Most of you were pretty upbeat actually, so that's great to hear. Let's move on to silver priced in US dollars on the daily scale, and yeah, this is much stronger than gold. You can just see from this pattern here, we're getting higher highs and higher lows, so we are in an uptrend now. So this is moving ahead of gold at the moment. I don't think that we're going to drop below this long-term trend line over here. So the maximum downside I see would be around here. That's about $25 level, but it may not even get there, to be honest. I'm thinking that we're going to kind of go up and down within this area here. So that's between 26 and 28. I actually think 26 will be support again here. So I'm doubtful that we're going to dip into that zone, but you know, I like to have a conservative, reasonable level as potential downside there. And what I'm looking for is for price to hop up above this line here, at just above 28, and that to be support. So for me, that's kind of the next stage. So we might kind of do something like this. And people get excited as it gets to 30, but it will just kind of move up and down along within that zone there. And people say, oh, well, you know, why do you think that? What's so important about these lines? Well, you have to look at the monthly scale and look back at price action from 2012. And people often say, in fact, when I was talking about this price move here, I think we were somewhere over here, and I said, oh, I think price is going to zigzag and then get stuck around here. I know that there are a couple of people who thought, oh, but everything's so bullish, why would it get stuck over there? And, you know, things were looking very positive and optimistic here. And it was purely that previous price action. So it was just the chart that told me that that was likely to happen. And you might think, well, 2012 was a long time ago, you know. Why would price kind of respect that kind of memory? Well, with all the talk of fractals that we had in the last couple of weeks, I actually started reading the book by Benoit Mandelbrot, which is called The Misbehavior of Markets. And amazing read. I've nearly finished it, and I definitely recommend it because it gives a completely different angle to the markets and all of this stuff, really. And one of the things it does talk about is long-term memory in markets. And I think it's probably one of the books that I'm most aligned with in terms of how I think about the markets. And it's certainly not a conventional way of thinking about it. And what you'll find, sometimes I find it quite hard to express some of these concepts, but he expresses them lucidly and it just makes sense to me. So definitely recommend that book. I've put the link for that in the description. Now let's just have a look at the miners. So this is the GDX on the daily scale, and again, pretty boring long correction here. Again, a lot of people are fed up with this now, and looks like we're forming potentially this descending triangle shape, and that can be bearish, but it can be bullish. It just depends on where this thing breaks out. If it breaks out above this line, then I think we're going to have a massive move up towards 54, I would say. A breakdown below this would, and particularly I think below 32, that would be very concerning. So if we break below and close below that line there, then I think we've got a lot lower prices to come, you know, in the low 20s really. But I'm not thinking that's going to happen. So when is this breakout likely to occur? I think it's still early, it's still forming. We just have to see how price progresses. But I'm thinking, again, just like gold and silver, I think it's going to go sideways. And we're looking early to mid-March really before we'll get an idea of where price is going. So I'm thinking something like this, in which case we'd be looking for more of an upwards bias here, but who knows? I mean, it could actually come down here first and move upwards if we are bullish about this. Now, I said that I like to try and look at things from different angles, and we had a couple of people mention volume and why I don't really look at volume. And part of it is because I just haven't been able to get my head around how to interpret volume. And yeah, I mean, maybe some of you have got some suggestions about ways of looking at it. I've got a couple of basic things like, you know, you look for high volume on a breakout and so on. And so there's a couple of things like that. But beyond that, sometimes I've found it to be a little bit misleading as well. So here's one example. This is the GDX on the weekly scale. And when we had this big pump up from March to about August here, that was a huge move upwards, and yet volume was below average and was declining that whole time. Now I thought if you had a big move up, you would expect big volumes as well, and so I don't really understand that. And through this downwards move, which I still think is a correction, volumes have continued to decline, which sounds like a positive thing, I think, because I think when you're looking at corrections, volumes should decrease. I'd be more worried if we're getting high volumes on these, particularly on these big down days there. But yeah, I haven't really sussed out. The other thing that doesn't make sense to me either is often when you get these bottoming formations with accumulation, you get a similar shape with volume, but we've actually got the opposite here. So I don't really understand that either. But yeah, it'll be interesting to hear what any of you think. But let's move on and look at the silver miners. So this is the SILJ on the daily scale. And this is the breakout line that we're looking for. We did poke above it, but price just didn't stay above there and we came back down. I'm thinking that this line here is the absolute low, but I actually don't think we're going to reach there. I think we've got reasonable support all along here, just based on the price action here. So I don't think there's a lot of downside. And again, I think we've got a bit more sideways movement to do, a bit more work to do. And in terms of trajectory, I'm thinking something like this with an upwards bias before we break out here in, again, mid to late March, I'm thinking. But look, who knows? Now, again, I thought let's look at volume with this index. So if we look at the SILJ in two ways, now there's two ways of looking at volume as well, that's the other thing. So one thing is that here volume is kind of doing that accumulation kind of shape here like this, if you look at the volume curve down here. So that seems to make sense to me a little bit. And interestingly, with this big price rise and kind of breakout, although it's there are red candles all along the way, which is a bit bizarre, volumes were high over that time as well. The other way of looking at volume is doing what's called volume by price over here. And what this shows is that the biggest volumes were traded at this price, which is about $14.60 over here. And that maybe that suggests that that's a support area as well. And that certainly fits with the price bars here that I was talking about earlier on. So if we do have downside, then that could be a potential bounce area before we do something like this maybe. And you can see that there's not much volume once we get above this breakout line here. But of course, it's unknowable because there's no prior price action here. But I think it'll be, once we stay above here, I think it could be potentially very strong beyond that. But yeah, I find volume quite puzzling. So if anyone's got any experience with using volume and found some kind of helpful tips and tricks, then let us know. That's it from me for this week. Don't forget to like and subscribe. And if you appreciate this content, then you can drop a tip in the join area. All the best and see you next week. Bye.